Imagine you walk into a bank with a stack of cash, real cash, notes you can touch, smell, fold. You hand it to the teller. And from that moment on, it's no longer really yours. Not because the bank is evil, not because there's a secret villain room, but because the moment cash enters the financial system, it stops being cash. And that changes everything. Most people think money is simple. You earn it, you save it, you spend it. But the modern financial system doesn't work on simplicity. It works on transformation. And the first transformation happens the second your cash crosses that counter. This matters right now more than ever, because for the first time in history, physical cash is becoming optional. And optional things are easy to control, easy to delay, easy to redefine. Let's slow this down. You deposit $1,000 in cash. In your mind, that money is now in the bank, safe, waiting, frozen. In reality, the bank doesn't put your money in a vault with your name on it. They record a number. That number is a promise, not a box of cash. Legally, the moment you deposit money, ownership changes. The bank owns the cash. You own an IOU. This isn't a conspiracy. It's written into banking law across most of the world. Your balance isn't your money sitting there. It's a claim against the bank. Usually that distinction doesn't matter, until it does. Now here's where the system quietly gets clever. Banks don't just hold deposits, they use them. Your $1,000 becomes the foundation for loans. Not one loan, many. Through a mechanism called fractional reserve banking, the bank is only required to keep a fraction of deposits available as actual cash. Historically, that fraction was around 10%. In some countries today, it's even lower. In some cases, effectively zero. That means your $1,000 might support $9,000 or more in new credit. Loans are created, mortgages, car loans, business credit. Money multiplies. But notice something subtle. That extra money isn't printed cash, it's digital entries, promises stacked on promises. The system works as long as everyone doesn't ask for their money at the same time. And most of the time, they don't. Because we don't use cash anymore. We use screens, cards, apps, transfers. Convenient, fast, abstract. Now here's the uncomfortable part. When people say, "I'll just pull my cash out if something goes wrong," they're assuming the cash is there. It isn't. If even a small percentage of depositors demanded physical cash at once, the system would freeze. Not collapse dramatically, freeze quietly. Withdrawals slowed, limits imposed, temporary measures. We've seen this movie before. In 2008, in Greece, in Cyprus, in Lebanon. The language is always calm, the experience is not. And here's the irony. The more digital and efficient money becomes, the more fragile the system underneath it gets. Because speed removes friction, and friction used to protect stability. Now let's talk about inflation. When money is created digitally through lending, it expands the money supply. More money chasing the same goods. Prices rise, but wages don't always follow. So even though your bank balance stays the same number, its purchasing power quietly shrinks. This is why people say, "I'm saving, but I feel poorer." You are. Not because you're bad with money, but because the system is designed to reward movement, not storage. Money that sits still is punished. Money that circulates is favored. Banks lend, governments spend, assets inflate. Cash holders fall behind. And the cruel joke is this: the safest looking option often carries the least protection. Now contrast this with the hype. You're told your money is safe because it's insured, and technically that's true. Deposit insurance protects you up to a certain amount. But insurance doesn't protect purchasing power. It doesn't protect access timing, and it doesn't protect against systemic freezes. It just promises you'll get a number back, eventually, in the same currency, at whatever that currency is worth at that time. Another quiet absurdity. Your money funds the system that slowly devalues it. Your deposits enable lending. Lending fuels growth. Growth drives inflation. And inflation erodes savings. It's not malicious, it's mechanical. Now zoom out. This system was built for a world of slow communication and physical limits. Ledgers updated by hand. Transfers took days. Cash moved trucks. Today, money moves at the speed of light. Risk does too. Central banks can create trillions with keystrokes. Markets react in milliseconds. Depositors are told everything is stable because instability spreads fast. And now we're entering a new phase. Programmable money. Central bank digital currencies. Fully cashless systems. Money that can be tracked, timed, restricted. Not necessarily to control people, but to control outcomes. Stimulate here, slow there, freeze this, allow that. Efficient, rational. And once cash disappears, opting out becomes harder. Because when money is purely digital, access becomes conditional. And conditions can change. Quietly. So what does all this mean? It doesn't mean banks are evil or that the system is about to collapse tomorrow. It means that cash is a word we use out of habit. What we really have is layered trust. Trust in banks. Trust in governments. Trust in stability continuing. Most of the time that trust is rewarded. Sometimes it's tested. And occasionally it breaks. So here's the unresolved question. In a world where money is no longer something you hold, but something you're allowed to access, what does ownership really mean? And how much of your financial life is built on assumptions you've never had to question yet?